Welcome back, everyone. The Jeff and Rick show meanders on. And we have a special guest today, our good friend Darren Bloomquist, Vice President of Market Economics at auction.com. Darren, welcome aboard.
Thank you so much, Jeff. Great to be here. And Rick.
We don't want to forget Rick.
Yeah.
So it is a super interesting time in the marketplace right now. We continue to look at exceptionally underbuilt supply side on most geographic regions around the country. The foreclosures seem to be ticking up. It's the wave that was predicted but never really came. Darren, I would love to hear your thoughts on trying to understand why the foreclosure activity continues to really remain so low, especially after all of these special programs that COVID rolled out. We expected all of these programs to dry up and then this tidal wave of bad things was going to happen. But here we sit in 2025 wondering where the foreclosures are. Darren, would love to get your take, and Rick, jump in as needed.
Yeah. And that's a question we're asking ourselves every day, but I think we have some good answers. I think number one, it's the massive amounts of home equity that was built up during the COVID stimulus period. And you saw home prices increase dramatically over that time, about 40 to 50%. So you have that equity that's kind of a firewall against foreclosure for many homeowners who get into trouble. And then second is there were all those generous programs that you talked about during COVID that helped prevent foreclosure, but they didn't completely go away. The moratorium went away, but you still had generous loss mitigation programs that were helping people avoid foreclosure. And specifically with FHA, you were having homeowners who could take out second loans to pay off their back payments. And even these second loans called partial claims could be used near the latter end of last year to help them make their payments going forward. And so those programs had not gone away. That FHA program I'm talking about is finally going away in October, slated to in October of this year.
Yeah, and we can't forget that fundamentally, we've been dealing with a very strong economy. Unemployment has been at or below 4% for, I don't know how many consecutive quarters coming out of the pandemic. And typically, there's a very strong correlation between unemployment rates and mortgage delinquency rates. In fact, when the Mortgage Bankers Association put out their most recent delinquency report, they noticed that there were about 4.04% of mortgage loans delinquent, and the unemployment rate was 4.1%. So you can't get a much stronger correlation than that. So, low rates of mortgage delinquencies, although they are increasing, also tend to equal low rates of foreclosure activity. And to Darren's point about some of these programs not going away, the forbearance program, which I believe was a very successful initiative between the federal government and the mortgage servicing industry, had about 8.5 million borrowers go through it. Less than 1% of them ended up in default or foreclosure. Just a remarkable success story. And that program technically is over, but we're still seeing about 250,000 borrowers in that kind of forbearance program today. Most of them have nothing to do with COVID anymore. It has to do more with natural disasters or temporary financial hardship that the servicer is trying to help the borrower work through. So, Darren made a great point about some of these programs that are still around. And, the other thing we have to remember before we keep going in the conversation is that even prior to the pandemic, we weren't looking at particularly large numbers of foreclosures. Foreclosure activity was running probably at about 60% of historically normal levels, even back then, due to a strong housing market and strong economy. And we're still not even back to those levels today.
Darren, one of the things that Rick and I have been talking about really for 3 years now is the tremendous amount of equity that has been built up across the single family housing stock in the United States. And how that is influencing folks who are getting into trouble and the path, while it may start as foreclosure, it just doesn't go very far. I
Yeah.
would love to hear
Mhm.
both your opinions on how that's looking today, and is that going to change at all?
Yeah, absolutely. I mean, equity is the number one reason I think that we haven't seen that foreclosure wave. People who get into trouble, and we see this, are have options. They have these loss mitigation options that are enabled in part, are able to happen because of the equity that homeowners have. But in addition to that, you just simply have the option of selling the home as a homeowner if you have a lot of equity. And so what we're seeing in the equity trends is they have kind of plateaued in the last few quarters. I look usually at the Federal Reserve's household balance sheet data. And if you look at that, you see that home equity has reached record highs of about $35 trillion nationwide. And and on a percentage basis, that's about 72% of the house value that they have. So this is massive amounts of home equity, but that has started to plateau. It hasn't really started to go down, but because we're seeing home prices level off and home price appreciation slow, I do think that we are at least headed toward a plateau in home equity, if not potentially seeing that go down in future quarters as homeowners also potentially take out more equity from their homes. And so that home equity cushion is dissolving. And then I would also say, or it's not dissolving, it's plateauing. But for specifically for homeowners who are in default, what we're seeing is they're draining their equity to a certain extent by these foreclosure prevention programs. And so they're even though their home values are going up, their balances are also going up because they're leveraging that equity to stay in the home. And so that's becoming a problem for those homeowners in default where that equity cushion for them is shrinking.
Yeah, I think the message for investors and for RCN's borrowers, Jeff, is that in today's market, and Darren's done some really, really good research on this, you probably still have a majority of borrowers in foreclosure selling the properties off before they ever get to the foreclosure auction. And so if you're looking for a foreclosure property, a distressed property as an investor, you really need to be targeting those homeowners in the early stage of foreclosure and trying to get the property there. And that's kind of a win-win scenario because you're helping them protect their equity and walk away with a check rather than run the risk of losing all of that at a foreclosure sale. And you're getting a property probably at least a little bit below market value. So I think that's an important consideration for investors in today's market who are interested in distressed properties.
Yeah,
So
I'll throw out one statistic there real quick is before the pandemic, we were about 35% of the properties that we had scheduled for auction on auction.com actually went to foreclosure. And now that what we call BTA rate, brought to auction rate, is down to about 20 to 25%. So there's more people who are avoiding foreclosure, to Rick's point, often by selling the property. We saw that writing on the wall a couple of years ago. We've actually introduced a program that allows those homeowners to list their properties on auction.com if they want to see if investors will bid those properties up.
interesting. Interesting. Well, the story continues to unfold. And Darren, I would think at auction.com, you are in super, super close contact with servicers and servicers making predictions about what the volume. Some of it, I'm quite sure, ends up on your platform, which does an amazing job of putting properties back into the marketplace through your auction platform. What are servicers saying to you today? What are they saying about what they see coming down the road?
Yeah, we actually had a client summit with our servicers back in April, so it's still pretty fresh. And what they were saying to us, there was a couple themes. They are seeing this slow rise in foreclosure volume that we've talked about. When we surveyed them, most of them are thinking about a 1 to 4% increase in foreclosure volume this year. So nothing crazy, dramatic. But the other theme that's emerging is that the properties that are in their delinquent portfolio have less equity. And that's something I alluded to earlier. But a year ago, when we asked them that question, they said the average LTV of the delinquent properties in their portfolio or delinquent loans in their portfolio was about 65%, so about 35% equity. This year, when we asked that same question, it was about 82% LTV. So that equity had shrunk dramatically. And of course, this is a survey, it's not hard data, but I think that shows the trend is more of those homeowners in trouble have less equity to as a bulwark against foreclosure. And then the third theme is that the biggest reason that they think that the biggest risk for higher delinquencies going forward is now exhausted loss mitigation and higher unemployment rates. Rather than last year when we asked that same question, they were saying that higher property taxes and higher home insurance were the biggest risks for higher delinquency. So that's shifted as well.
Rick, I can't help but wonder, as we look at the national unemployment rates, I'm wondering how the movement in that rate is actually tracking on the properties that end up in foreclosure, if that truly is the reason that folks are giving.
Yeah, Jeff and Darren and I have been watching this industry closely now for the last 20, 25 years. There is no more accurate predictor of foreclosure activity than the job market. There just isn't. And if the economist fears about the country entering a recession or having a significant economic slowdown come to fruition, we will see jobless rates go up, and we will see mortgage delinquencies and foreclosures go up. The ratios maybe are a little different than they were 20 years ago. But again, if you're looking for a way to predict how much foreclosure activity is likely to be coming down the road, the unemployment number is the first place to look.
Great way to end this segment, gentlemen. Thanks so much.